You're about to hear my conversation with Arup Datta, who leads our Quantitative Global Equity team. He's just celebrated his 5-year anniversary on his track record of the McKinsey Emerging Markets Fund. Arup talks all about what has changed in quants over the past 5 years and where he thinks the business is going. I hope you enjoy. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to the McKinsey Investment Podcast. My name is Matthew Schnurr, and I'm delighted to be here with Arup Datta. Arup leads our global quantitative boutique. Arup, welcome back to the podcast.
Thank you, Matt. It's nice to be here.
Arup, I've had you back as a bit of a celebration. You're the first mandate that you came to McKinsey and started managing, which is the McKinsey Emerging Market Fund, has just reached 5 years, which is an important track record date for many managers. Over those 5 years, we've seen an exceedingly good performance. I'm referencing numbers sort of at the end of May, but you're in top decile within that category for the emerging markets over 3 and 5 years and 1 year. So really an excellent job. And Arup, what I really want to spend the conversation talking about is just how quantitative investing has changed over the past 5 years, and then also looking forward from there. So maybe I'll start by just asking you about your experience at McKinsey. I know that you joined about 6 years ago, but how's it been so far?
Thanks, Matt, for asking. It's been a pleasure to be part of McKinsey for now almost 6 years. I believe I'm just a few months shy of my 6-year anniversary in September of this year. As you alluded to, for quantitative managers, when you are hired, you have to build your stock selection models, risk control, portfolio construction from scratch. It takes few months. So that's why, even though I've been here almost 6 years, we just hit our 5-year track record for our initial launches, including the McKinsey Emerging Markets Fund. I would say it's been a real pleasure being here. One of the reasons I joined McKinsey was the boutique structure, where I get to do, or my team gets to do what we do best, in my view, which is focus on investing, whereas the larger McKinsey organization takes care of everything else. And that's worked out exactly as we had hoped for. Another reason we had joined McKinsey was McKinsey is a large Canadian asset manager, and we knew it would be a source of funding for us to launch different strategies. And I'm happy to say that we have really used that advantage to launch many strategies throughout the world. Though again, I'll note that the McKinsey Emerging Markets Fund is a flagship launch, and now just north of 5 years in terms of track record.
That's great, Arup. So thanks for the background. I appreciate the comments on your experience at McKinsey. Let's turn to sort of your bread and butter, which is quantitative investing. Maybe we'd start by sort of going back 5 years or 6 years when you started to rebuild your models, and just to try to have a better sense of what's changed from where we are today versus when you started to rebuild those models.
Absolutely, Matt. So I'll start with what's remained a constant for me. This is my 31st year in the equity markets and 30th as a quantitative equity portfolio manager. One thing I've always prided myself on is trying to be as core, or another word is as all-weather as possible. I don't want to be put into buckets of I'm a value manager, or I'm a growth manager, or I'm a quality manager. I like to employ all of those ideas, and I'm mentioning only 3 because markets tend to be usually value market or a growth market or a quality market. I tend to use all of those ideas when I pick stocks. And therefore, that philosophy of being core or all-weather has always remained with me. Of course, as I learn from the markets, I tend to become more and more robust in trying to be all-weather. But what has changed underneath it are various factors we quants or quantitative investors use in picking stocks. So let's say we have 3 main super factors: value, growth, and quality. I'll next like to touch on a lot of the innovations we have done here in the last almost 6 years we have been at McKinsey. I'll start by saying that having done this for 30 plus years, the last 6 years have been the richest 6 years I've, in terms of new ways to pick stocks that I've unearthed in the 30 plus years I've been doing this in the industry. So I have a terrific team. Many of us came together from the previous shop and we have put our heads down and found many new ideas. The last 5 years have also been very rich for quants in terms of a lot of new techniques coming into play. Artificial intelligence, natural language processing, machine learning, a lot of the buzzwords. And we tend to employ all of those in terms of our factors today. And I would say AI, machine learning, NLP, we had no factors employing those ideas when I joined McKinsey almost 6 years back.
Right.
So let me walk you through, Matt, a few different factors that we have added, and in no particular order. Firstly, we added a new idea to value stocks, which is what we call comprehensive value. And I would say this is, I'll start with this, and I like to give the Tesla example in the US. There are equivalents of that throughout the world, but I think being North American, we can perhaps understand the Tesla example better. Tesla, in the GICS standard definition, which is what all investors use in terms of doing peer relative valuation, right. Tesla would be bucketed with other auto manufacturers like Ford, General Motors, Toyota, and will always look exceedingly expensive, whether right. very expensive or somewhat expensive. So what this new factor, comprehensive valuation, does is goes around the GICS classification in defining peers. So we've looked at other classifications. There are databases out there which define competitors for you. And in that, if you look at Tesla's competition is not just your auto manufacturers, but it's also Uber, because Tesla's trying to be in, self-driving motors, or even NVIDIA, which is in the semiconductor space. So if you take all those into account, suddenly Tesla's valuation does not look as prohibitively expensive as it may in the more traditional definition of valuation.
I see.
So that's again going towards making our process more robust, keeping with the times. One more point on that is GICS did this to us. MSCI GICS, S&P GICS did this to us about 5-10 years back by breaking out in the US Alphabet, Microsoft, and Amazon into 3 different sectors. But right. Guess what? As we all talk about cloud services, those 3 are the largest competitors in providing cloud services. So therefore, that's why a new way of valuation, a new way of peer definition is definitely required. And that's something we embraced a few years back. So moving to the next idea, Matt, it's ESG, especially in Canada. There's a lot of talk about, COP26, COP27, what we are doing to the environment, etc. I would say starting 2.5 years back, we added ESG as one of the quality factors we look at when we pick stocks. Again, this idea was all built by us. It took a lot of time and effort building, the exact ESG factors we want to look at when we rank energy stocks amongst each other or when we rank technology stocks amongst each other. Right. We did all of the work in 2020 and employed this ESG factor as part of our quality framework. Again, to me, ESG speaks to the quality of a company, and we added that to a quality framework under the quality super factor about 2.5 years back. So I would say that's another addition we have made in the last 5 years since I've joined. Now, segueing from comprehensive valuation in ESG, let's go to a specific country, China.
Oh, sure.
We did a lot of, and the reason I'm talking about China is even though it's becoming a smaller weight, it's still a dominant weight of the MSCI Emerging Markets Index today at about 30%. Right. So as China was a big part of the benchmark and also of a universe, we started looking at whether we have the right mix of quantitative way to look at stocks for China as we have in rest of Asia. Historically, I've looked at emerging Asia as one region where what that means is for India versus China versus South Korea versus Taiwan, we'll be using the same amount of valuation when we pick stocks, the same amount of growth, etc., in terms of how I figure out the ranking of a stock. However, when we did our research on China about 3 years back, we figured out that China is a slightly different beast compared to the rest of Asia, emerging Asia. Why? The why is very simple. There's a reason why there's a major rivalry going on between the US and China in terms of technology dominance.
Right.
US is not having this rivalry with any other country in the world. The reason is the Chinese have become very innovative and they have their growth stocks in all sectors of the world. Unlike other countries like Korea, Taiwan, where Taiwan, all of the growth stocks are in the semiconductor field.
Sure.
So what does that mean? If you have a lot of growth stocks from EV manufacturers to semiconductors to pharmaceuticals in China, a lot of growth names, what that tells you is perhaps the growth factor needs to be used more in picking stocks in China compared to rest of Asia. So that's what we unearthed. When we did this research, we figured out that the more optimal way to pick Chinese stocks used to use a little bit more emphasis on the growth parameters of a stock compared to what we do in rest of emerging Asia, where it's much more of a balance between growth, value, and quality. So that's how we broke out China in terms of stock picking. We only look at Chinese stocks amongst each other, employ more growth in that process today versus rest of Asia, where we use more of a balance. So I segued from comprehensive valuation to ESG and now to China.
Right.
Now, the fourth idea I'd like to talk about is, as I said, the last 5-6 years have been very robust. I want to talk to you about 5 or 6 ideas on this, Matt. The fourth idea is making a process even more robust in terms of its core or all-weatherness. What do I mean by that? Historically, for quantitative stock pickers like me, the way we looked at growth was looking at sell-side analyst changes in their forecast for a company. Are they raising the earnings forecast of a company? Are they raising the sales forecast or dividend forecast? Those are the catalysts that you need on top of valuation when you want to buy a stock. But what was lacking, and I'm glad that we unearthed this in 2019, was that this is all short-term growth. Analyst revisions, all that tells you is where is the earnings going today versus what I thought it was yesterday.
Right.
It's missing the bigger picture or the long-term growth. So we did a lot of work on long-term growth, which is not looking for today versus yesterday's growth, but looking for the last 5 years growth of a company, actual terms, and the next 5 years forecast growth from a company from an analyst perspective. So in other words, the long-term growth measure looks at the 10 years of growth for a company and makes our growth measure a much better balance between short-term growth and long-term growth. Towards that, we also look at things like innovation, patents, etc., all in that mix. So therefore, by adding this, we made a process more robust, and this is what has really enabled us to stand out, especially across quant managers in 2020, when many of them struggled, whereas we had a strong year. And I'll also say about this year, where we're having a strong year in emerging markets, in most of developed markets, and that's because we added a lot of this innovation, long-term growth to our mix. And guess what are the stocks that are leading the charge this year in the US? Those are the Nvidias of the world and names like that, where on a valuation basis alone, you won't own them. But if you look at their long-term growth metrics like that, you're likely to own them as we do. So that fourth idea was about making us more core. Then let's move on to the latest and greatest that quants are talking about. As I mentioned, text parsing, which was off limit for us quants, which is you can use computer codes to look through any text, whether it's financial statements, whether it's management reporting section, whether it is sell-side analyst reports, any other text. It's all under the NLP framework called natural language processing. And I'm happy to say that we are using some of those techniques looking at, say, financial statements, 10Ks and Qs, or the equivalents in rest of the world, and making some inferences based on the text companies are using. And that's been a part of our process for 3.5 to 4 years now. That's on the NLP/linguistics front. And now we are not only doing it in the English language where we started. In the last 1 year, we have added it in Korean, Mandarin, and Japanese languages, which makes us use it also in areas like emerging markets, which we did not do early on when our initial models were built in the English language. And last on this framework is ending with machine learning AI. I would say I give my team credit to have figured out using, and to me, what machine learning AI are all really non-linear techniques,
Right.
where basically we use much more recent techniques to figure out, is there a better way to rank a stock? And I can tell you, my team has really put in a lot of effort there. And we came up with a new idea called fundamentals prediction, which is using this technique, machine learning AI techniques, we are actually better predicting various fundamentals of a company, like the dividends or the sales of a company. And we are doing a better job doing that than sell side analysts are. And so that's the last factor I want to talk about. It's called fundamentals prediction. And we just employed it in our live process about a couple of months back.
Okay.
So in summary, Matt, a long-winded answer, I just told you how we have made improvements to valuation, comprehensive value, quality, which was things like ESG, and then growth, which was long-term growth, fundamentals prediction, machine learning, NLP, etc.
That's wonderful, Arup. I appreciate the comprehensive answer and touching on such a broad amount of work. I suppose it has been your life of work for the last 5 years, so I'm not surprised that there's a lot to go through, both you and the team. What I did find interesting, I love your thoughts on this. When you opened that answer, you talked about what I expected you to talk about, which is AI, natural language processing, machine learning, all sort of the buzzwords that I intuitively think apply to quants and quantitative investment management. But when you go through these different changes that you've made, a lot of it isn't really technology based. This idea of comprehensive value and putting companies together that are actually better peers, ESG, recognition that China deserves its own model, all of those really aren't technology driven. Do you expect the next 5 years to be more technology driven, or do you still think that there's going to be lots of opportunities to apply what I'll call bottom up, sort of non technology driven research to improve your process?
So I'll hedge myself in this by answering that
Sure.
will be both. Just as I shared with you, the last two factors we unearthed that I talked about were really what I call technology-based NLP, machine learning, AI. Whereas Matt, as you pointed out, ESG, comprehensive value, more robust long-term growth, are more, just becoming a better investor, which is what we have done all through life. As you learn from the market, get better. I would predict the next 5 years, which will not be any different than the last five. Yes, one thing I can predict is, just like other strong quant managers, we continue to deploy a lot of resources towards machine learning, AI, NLP. Just like we have taken NLP so far to English and then to Mandarin, Korean, and Japanese, we'll now take it to other countries.
Right.
And see how it works in other languages. That's the difficulty of the whole world. We speak many different languages, and some countries speak many languages even within itself.
Sure.
So I would say there'll be still more work we'll be doing on the NLP front. Again, an area where when I joined McKinsey almost 6 years back, it felt like it was off limit to me. And that was an area where I thought my wife, who is a fundamental equity analyst, was really good at, and quants could not get there. And today, that's really fertile ground for us, and we'll continue our work on that area. Similarly, just like we have predicted, fundamentals better, I'm sure we'll find out new ways of doing things using machine learning, AI, techniques like that. And even those techniques, Matt, will change. Those techniques are fast moving, and you need to be on top of that. And that's why we're a very strong team, many of them very recently schooled, combined with experience like me. But I'll go forward. But on ESG, for example, I think that's a moving target. ESG is one thing where when I first did my ESG research before I joined McKinsey at my previous shop, it was all about governance. That's what seemed to be the dominant factor. But the last few years, as I've done ESG work here, firstly when we employed version 1, and then we have just employed version 2 of our ESG model just a couple of months back. That was only 2 years after we launched version 1. And the reason I'm saying this is ESG data is getting better and better every day as we speak. The data was rather not so good 5-10 years back, getting better. And also the market's focus may be changing there from governance to environment and perhaps social in the future. So with all of that, ESG is one area we'll continue to revisit every 2 years to see, if we can do a better job of predicting ESG credentials of a company today based on all the new data out there compared to what we could have done 2 or 4 years back. So I call this more traditional, as you mentioned, Matt. One more towards traditional, just like I figured out long-term growth in my mix as making me more all-weather. I'll continue to be trying to be as robust and all-weather as possible. So that the main reason is I don't want to be exposed in markets and go to a client and say, oh, this was a value environment and I'm a growth manager, I struggled, or vice versa. That's not an example I like to usually have to say, or an excuse I would like to say. So therefore, I try to avoid that. So if I find other ways to make us more robust, we'll continue to work on that. And last but not the least, on this framework, we are also spending a lot of time on timing stuff. And again, I'm an old school quant where I like to use a good balance of value, growth, quality in my process for most of the time, not all the time. What do I mean by that? Sometimes you get a eureka moment or a huge opportunity where you want to actually bet on one of those three ideas more than usual. I've done it 3 times successfully at the height of the global financial crisis, the internet bubble, and also the pandemic, where the value opportunity was so huge that we put extra weight on valuation as we pick stocks. And then as it played out, the value opportunity became less so. This time around the 2022 framework, we undid that and went back to a normal mix. Having successfully timed value in what I call 3 sigma opportunities, which has so far happened only once every decade for me. I would like to spend resources, or we are, towards seeing, can we also time things like growth and quality? Is growth looking way too expensive? Should we now sort of, underweight that factor for a while now? Same with quality or vice versa. So that's another area where I would like to see if we can time some of our factors, but only in the extreme cases. That is, when it's a 3 sigma opportunity, because if you time things early, you can be wrong for a long period of time, which I don't want to be. So to me, these are sort of the frameworks we're looking at. You never can predict where you'll end up, because as you do research, some research does not pan out, others pan out. But in answer to your question, Matt, it's a good blend of the latest, greatest, and what I call more traditional investing, which has been around forever.
Right. I love that answer, Arup. It makes a lot of sense on where you see the business going. Maybe one last final question. That, as you were speaking, and I've personally been wrapped into sort of ChatGPT and these different models that allow classical history majors like myself to dabble in sort of computer technology in a little bit more robust way than we have been in the past. Do you think that there will be a inevitable conversion of quant and fundamental? Given how easy some of these tools are to start using, do you think fundamental analysts start using it a lot more, and vice versa, given that machines are now able to do text parsing and the like, that perhaps the two disciplines become more similar as opposed to less?
I would argue that the two disciplines have already got a bit closer than they were when I joined the industry,
Sure.
And I would say you're right. ChatGPT makes anyone who becomes better at what they call prompt engineering, a buzzword these days, which was not really around 10 years back. If you do a little bit of practicing, you can ask the right questions of these kinds of databases and get the right answer. You need to spend some time towards that, which, as you said, Matt, you don't need to be a programmer to do that. Those are all in plain English. So to me, yes, using ChatGPT can make it a little bit more of a level playing field. The way we are looking at ChatGPT is our understanding, and we are making steady progress towards that, is can we use it to make us even more efficient? I believe I run a very efficient 10% elite team, in my view, who are very well trained and have a very high productivity. However, what we are finding out, this is early stages for us, is that if you use ChatGPT, perhaps you can done 50 to 80% of your coding in no time by employing ChatGPT. And then you can use all the skills you have, the smartness you have, to perfect it and get the rest 30 to 50%. I can see us going that way in terms of a use of ChatGPT. It will just make you more productive. So in that sense, I think it may help out both quants and fundamental managers in terms of making you more productive. But of course, as I said, you need to put in that time and effort to make sure you're doing it the proper way, because ChatGPT also is known. We have already done all those test cases where they've given you wrong answers. So you want to use ChatGPT in the area where it's strong, like coding and so on, and not in the area where it may not be strong, at least as it stands today.
Right. Well, Arup, let's call it there. Thanks so much for spending time. Congratulations on the 5-year track record of the emerging markets product. Just phenomenal. And I look forward to the next 5 years. Thanks, Arup.
Same here, Matt. Thank you so much for having me on. It was a pleasure talking about all this.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may be associated with mutual fund investments. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.